Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
I'm doing great. It's a pleasure to be here, Ross.
Great to have you here, and fortuitous because once again we find ourselves talking the day after a Fed meeting. They raised interest rates as expected, 75 basis points. But I think the big takeaway for most investors was the hawkish tenor that Fed Chair Powell presented at his press conference. Markets sold off into the afternoon. But still, I'm curious. I want to turn it over to you. What's your big takeaway, and how does this affect your outlook for the rest of the year and into 2023?
Yeah, well, two big takeaways. One, I would say Powell was much more hawkish than the statement itself. There seemed to be an air of him trying to assert that he's in charge of the Fed, that he's the one who makes the final decisions, that he's essentially the Fed chair. And there was some contradiction between his comments and the seemingly dovish Fed statement. In particular, the statement itself, as well as Powell, have hinted that they're ready to slow the pace of rate hikes, which is no surprise. We all expect that. And we expect that slowing to come as soon as December with a 50 basis point hike in December rather than 75, and very likely a drop down to 25 basis point hike in January of next year. That seems consistent across what the market was expecting, what Powell said, and what the statement said. That's kind of the numbers of what we're expecting to happen over the next few months. But Powell reiterated at the post-FOMC press conference that just because the pace may slow doesn't mean that the terminal rate itself is going to be lower. In fact, he indicated the terminal rate is going to be higher than what their last expectations in September suggested. And as a consequence, the market has had to price in now a terminal rate approaching about 5.25%. And what that means for the entire US curve is that you're expecting now that peak yields still have not occurred, particularly between the 0 and 5-year part of the curve. So no surprise, 2-year yields jumped drastically, 1-year yields jumped drastically, because if the Fed is going to terminate the funds rate at 5.25%, even if they get there slower than expected, the terminal rate is what matters for the 1, 2, 3-year part of the curve. And it's also very important for about the 5, 7, 10-year part of the curve. So the entire curve has shifted up. Yields have jumped. And you've seen this morning, as of this morning, bigger losses in the bond market than we've seen for about 2 or 3 weeks now. So this is back to those levels. We're getting close to peak yields, cyclical highs again in 10s, and we're at cyclical highs in 2s, 1s, 2s, and 3s. So that's kind of the be all and end all of where we stand today. But it's important to note that this is probably the worst possible outcome for the bond market. A slower pace of rate hikes, but a higher terminal rate. Now, if this were said to us back in March, we would be much more concerned because it would have suggested that the bond market has a great deal more pain to come for months ahead. Because this is coming in November, there's a little bit less anxiety from this, but this is still a bad news for the bond market. Higher terminal rate, slower pace means worse outcomes for 5, 7s, 10s. And one more point I'll make, and sorry to be long-winded on this, is that the longer the Fed takes to terminate the funds rate, the longer it's going to take for them to curtail and stop balance sheet reduction. And that does disproportionately affect the belly of the curves, the 5s, the 7s, and 10s. So the Fed has more time to reduce its balance sheet if they go slower with rate hikes.
So I guess my follow-up would be is do you believe Fed Chair Powell? Do you think that they have it in them to continue raising rates, as you mentioned, into a longer part of next year than had previously been expected, as the risks of recession and global recession continue to mount? Do you think that they will be able to follow through on that, or do you think that the weight on economic growth from both the Fed activity and other things globally will cause them to have to pivot? The market's looking for that pivot at some point in the first half of next year.
Yeah, I honestly, candidly, I do not think they're going to be able to bring the funds rate to 5.25, which is roughly what the market's pricing as of right now. I don't think they're going to be able to bring it to 5%. I think they're going to struggle to bring it to 4.5%, which would mean that the next tightening in December could be the point at which they pivot, we'll say in January, and maybe they can get one more hike at 25. But the problem that the Fed is going to face is that you're almost assured a recession now in the US sometime between now and we'll say the end of the first quarter next year. That's almost a certainty at this point. The only question is, how deep is it going to be? If they bring the funds rate to 5.25%, we're talking about no longer a shallow recession. We're talking about an extremely painful recession, and quite possibly one that has credit market implications around the globe, because there's going to be a dollar shortage. There's a squeeze on dollars. The Fed funds rate is simply too high, and the currency markets have to reflect that, and dollars are going to be in short supply. So I don't think the Fed's going to be able to bring the funds rate up to 5.25%, but I think Powell is determined he's going to try his best to get it there. And the reason is because, simply put, inflation is sticky. So you need a higher funds rate and for longer to wring that inflationary inertia out of the system. So he seems determined to do that. Whether he can, I doubt he can. I doubt he'll be able to.
So the final question I'll ask then is, how do you position in fixed income for this sort of environment, right? Higher terminal Fed funds rate, potentially later next year, but also balancing that recession risk that could really hit the longer to the curve potentially.
Yeah, what this means is that tracking error, particularly in benchmarked fixed income strategies, if you're benchmarked against the Barclays Agg, you have to be willing to tolerate a higher tracking error than what you've seen over the last few years. That is because we are recommending clients continue to utilize active duration management. When treasury yields, particularly the belly of the curve, gets oversold, 5-year, 7-year, 10-year yields hit new cycle highs, that's a good time to add duration. We're not saying we're calling a peak or a top in yields, but what we're saying is eventually the reversal lower is going to reward bondholders. But you have to be willing to tolerate the tracking error risk, the volatility versus your benchmark, because you are putting on active duration bets. Likewise, if yields were to gap drastically lower, investors who have put on those longer duration positions should be willing to take them off quickly, because we are very likely to be in a mean reverting volatile environment with volatility to both sides. And lastly, investors should continue to move up in credit quality, use every opportunity they can to move up in credit quality, particularly into an investment grade only or investment grade majority position or portfolio. We do think the high yield space is going to see the brunt of its pain next year, whereas the investment grade space has felt the brunt of its pain this year.
Tom, this has been incredibly insightful. Thank you so much for the time. Hope to talk again soon.
Thank you.